Hello and welcome to the session in which we will discuss attestation risk of non-compliance. What does this concept refer to? Attestation risk of non-compliance. Well, that's the danger, the risk that what? The risk that an auditor or some professional that might fail to do what? To issue the correct opinion about the compliance when necessary. So someone asks you to issue an opinion about a compliance. Well, there's always the risk that the auditor might issue the wrong opinion about the compliance. Well, this sounds like issuing the wrong opinion about the financial statement. Basically, it's the same concept. Here we are dealing with compliance, not financial statement, but the risk is the same. It's the risk that you encounter when you prepare audited financial statement. And it consists of three main components which we should be familiar with. That's the audit risk of non-compliance, one, that's set by the auditor, and to have a peace of mind, you want to set this low, because we're going to see why you want to set it low if you want to have a peace of mind. So the audit risk of non-compliance equal to the risk of material non-compliance. Hold on a second. This sounds like the risk of material misstatement, RMM. Well, here, we don't, since we are doing compliance, basically it's the same. We're going to call it the risk of material of non-compliance, RMN, which is composed of inherent risk times control risk. Basically the same thing so far. Then we multiply this by detection risk. And detection risk is the risk that's controlled by the auditor. How much work do they want to do? Exact same thing in the audit risk model. So if you viewed the audit risk model, which you should completed the audit risk model before you get to the attestation of risk for non-compliance, you're going to hear the same thing. However, in this session, I am not going to go in depth as the audit risk model and use numbers and percentages. I am going to be using theory, but I'm pretty sure you can follow. So what we're going to do, we're going to revisit each component, then put it all together and wrap it up with a multiple choice question. Let's go ahead and get started. Starting with the inherent risk of non-compliance. Remember, the inherent risk of non-compliance is part of the RMN. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. The risk of material non-compliance. What is inherent risk? What is inherent risk? This is the natural level of risk. The risk that exists for non-compliance, associated with non-compliance in a particular area or a process or a system, assuming there are no control in place to mitigate this risk. So the inherent risk is present in the environment independent of any control, just it exists by its nature. It's the inherent possibility of material non-compliance due to the nature of the compliance requirement itself. Well, in the auditor, there is nothing they can do about this. If an industry is highly risky, it's inherently risky, there's nothing you can do as an auditor. You are aware of this. So you're just basically walking in a field of mine, so you have to be very careful. So auditor cannot change inherent risk, but they can reassess it based on the evidence they gather during the audit. They can learn more to set it higher or to set it low. For example, consider a company operating in an industry that's heavily regulated for environmental protection. The inherent risk of non-compliance now is high due to the complex and strict environmental laws because they are highly regulated. They work in an environment that there's a chance that then there might be violation. Well, if the company is engaged now in activities with significant environmental impact, and most likely they would be if they're highly regulated, like let's assume they're in the chemical manufacturing, well, there's an inherent risk of violating these regulations is very high, irrespective of what controls the companies might have. Irrespective of that, there is an inherent risk, irrespective of any controls. Now, the control risk, on the other hand, is the risk that the possibility that the company's internal control are inefficient, or they fail to prevent or detect material non-compliance on a timely basis. So control risk is the other part of the RMN. So it's inherent risk times control risk. What is control risk? Control risk is that the company's internal control are not efficient, they are not working properly to do what? To detect those non-compliance on time. Now, like inherent risk, control risk exists independently of the audit, and it's not directly changed by auditor. The auditor cannot change control risk. If the company, if they don't have good control, you can tell them, talk to them, you can assess it, but there's nothing you can do. The auditor will assess the control risk based on the audit evidence. Okay, so how the auditor's assessment of this risk can change also based on the audit evidence. At the beginning, you might thought they have good control. You find out they don't have a good control. So control risk is the risk that the internal control will fail to detect the non-compliance instance. For example, if the chemical company that we discussed earlier has weak internal control for monitoring and managing waste disposal, there is a high control risk of non-compliance because they don't have a good system of controls to do what? For the waste, to manage the waste from the chemical company. Even if regulations are stringent, it doesn't matter what the regulations are. Here, the company's internal control are no good. Poor internal control might fail to prevent or detect non-compliance. Here, the internal control is failing you. So if you have high inherent risk and high control risk, it's really bad. It means the environment in which you operate is risky and your internal control are not working properly. So RMN is IR, inherent risk times control risk. The interplay between these risks is crucial in determining how you approach the audit. When the entity has strong internal control over compliance, well, the auditor can place what? Greater reliance because they have good control. And this reliance could lead to fewer detailed tests because you're relying, or a lower threshold for quality of evidence required because you kind of trust the system. The system is catching the errors. On the other hand, if a company has weak internal control, what's going to happen is you're going to have to do more extensive testing and higher quality evidence is needed to ensure compliance because you cannot trust them. So this is how they trust them in trusting non-compliance. So you want to make sure you understand how inherent risk and control risk play in this larger formula. Let's talk about detection risk. Detection risk is set by the auditor. What is detection risk? Detection risk is the possibility that the auditor will not catch a material violation or a failure to comply with relevant regulation or standard that are present in the entities being audited. So the risk that you are taking that you will not catch it. So this risk is specifically linked to the auditor's approach. It means what? It means they can control this risk in terms of what? In terms of the amount of work that they do. And what type of test do they choose? How thoroughly they test things and when they conduct the test. So an auditor can reduce this risk by enhancing the quality and depth of their audit procedures. So just to kind of make it simple, for example, if an auditor is reviewing the company's financial transaction for compliance with tax laws, now if the auditor is only conduct a superficial review of a sample transaction and late in the fiscal year, well, there's a high detection risk that significant non-compliance, such as unreported taxable income or incorrect deductions, might go unnoticed because they did not go in depth. To reduce this risk, how do you reduce this risk? Well, you could increase the sample size, include transaction from different part of the year, and apply more rigor testing. So the more work you do, the lower that risk. You would lower the detection risk because there's less chance of missing something if you do more work. Now, let's just make sure we understand the relationship between detection risk and the level of assurance. And the relationship between them is negative. If you want to lower, if you want higher level of assurance, if you want more assurance, if you want more peace of mind, you have to lower your detection risk. You have to lower your detection risk. It means you have to do more work. You want better results, a better level of assurance, you have to do more work, you lower your detection risk. So the relationship between detection risk and the level of assurance is inversely proportional. When one goes up, the other one goes down. as auditor seeks to level the acceptable level of detection risk, it means what? Aim for higher probability of detecting non-compliance. They must do what? They must increase the assurance provided by the detailed test. So you have to do more work. This includes conducting thorough tests on specific transaction, reviewing the implementation of corrective actions from previous audit, and look for more convincing evidence. So in essence, more rigorous and extensive testing is needed when the auditor aims to lower detection risk. You want higher level of assurance, you lower the detection risk, but you have to do more work when you lower your detection risk. If you set your detection risk at 15%, it means you want to be you're 85% assured. If you wanted to set your detection risk at 10%, you want to be 90% assured. If you want to set your detection risk at 5%, you want to be 95% assured. You're still taking risk, but at only 5%. If you want to set your detection risk at 0%, which is kind of, you have to do audit everything and you're still taking risk, then you want to be assured 100%. So when you lower this, notice as you lower this, you are taking a better chance of getting it. Let's take a look at this multiple choice questions from farhatlectures.com. In an audit, if the inherent risk of non-compliance is high, what impact does this have on the auditor assessment of detection risk? Well, do we understand what inherent risk? Inherent risk is the risk that exists because of the nature of the account, of the industry, of the company, of the compliance itself that we are dealing with. Well, how is that going to affect detection risk? Detection risk is the risk that you might miss something. Okay? So, if the environment is high, what happened to detection risk? The risk of missing something. Is it going to be high? Does it increase or does it decrease? Okay? So, it decreases the detection risk. It has no impact. Well, it has an impact, so we can take out B out. It increases the detection risk. It necessitates a reassessment of the control risk. Detection risk and inherent risk are independent of the control risk, so we can take D out. Now, the question is this. If you work in an environment where it's inherently risky, what happened to your detection risk? Are you more likely to miss stuff or less likely? Taking only inherent risk high, if the inherent risk is high, it means the environment that you operate in is highly risky inherently, then your detection risk is higher. There's a higher chance of missing something. Therefore, the answer is C as in Charlie. What should you do now? You want to go to Farhat Lectures, look at additional resources. Again, this lesson is a mini lesson of the audit risk model. So if something does not make sense or you missed the audit risk model, go back and view the audit risk model. As an auditing student, as a CPA candidate at this point, if you're studying about non-compliance, you should have looked at the audit risk model. Farhat Lectures can help. Invest in yourself, whether you are a CPA candidate, accounting student. Good luck, study hard, and of course, stay safe.